Welcome back to the channel, Crypto Trend Trader, with a quick update on Bitcoin. Before we get started, I'd like to remind you it's not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. Alright, here we're looking at the Bitcoin chart here. I'm on the 4-hour Coinbase, and as you can see, we basically had our moving average crosses on the daily in purple when they're to the downside, and green to the upside. And then our 4-hour moving crosses on a 4-hour time frame, it's blue and red. And once we got the cross up here and we're unable to save it, it came down, got the daily moving average cross, and then capitulated to the bottom of our descending broadening wedge with the orange line on the bottom and the red line on top here. And when we capitulated down, we found support at the bottom, fib zones corresponding the 786 of the single move right here, but more importantly, in green fibs here are the entire move up from our head and shoulders at the previous bottom here in like the 6,500 range. So we came down to the 0.5 already of that move. It's not unrealistic to think we could get a move as high as the 236 back up to like the 95.50 range, but we could just get stopped again at like that 9,000 range and rejected and see lower prices. We did see confluence here with some of our other diagonal lines, but more importantly, we can see this interaction that's taking place with this previous diagonal trend line. And when we had come down here, again, people see a pattern work one time and start calling it out like crazy, and it's important that you know what these patterns are and what they represent. And in this case, this is not an inverted head and shoulders people are calling out here. It doesn't look right at all. I mean, you could call it a slanted inverted head and shoulders and say the neckline is just slanted like really bad, but it doesn't really make any sense. You need to see symmetry with these patterns, because the point is that they represent actual, like the price action itself on the chart represents like the psychology of traders and market makers. And that's why like the symmetry in these patterns is what allows people to identify them and know that they're valid. Otherwise, you're just gonna, like, every time you see, oh, it comes down, then comes back up, then comes down, then comes back up, that's a W, we're going to higher prices. No, it doesn't work like that. You need to see symmetry in these patterns, because that's what tells you when you break like a solid neckline or something like that, that the pattern is validated, and then you're going to see like that measured move. And then still, even after that, it's important that you know like what would cause a measured move of a pattern to underperform or overperform, or when that pattern is more likely to play out percentage wise, etc. So it is important that you actually know about these things, not just the 2-second crash course. So but anyway, now you'll see we also started basically finding like some serious resistance on this descending line inside of our broadening wedge. And now here we are, we're all the way at the bottom of these three lines in purple, orange, and green, and we're in line with the 0.5 Fibonacci, the 786 in blue, and then on our like broader time frame, we have the green and the orange both represent just whether or not it's affected by log scale. Although I am looking at a log scale chart, I just like to see both potential views at the same time. So we're basically, we're at that 0.5382 area right here. We could potentially get that move back up, but what it looks like now is if we do break out of this pattern right here that we're forming, we could potentially break this and then get our measured move up, stay inside the descending broadening wedge, move up to like the 382 of the Fibonacci in blue right here, or the 236 in green like we were saying in the beginning. That also lines up with the 0.5 of our orange Fibonacci. So again, we could get that move back up somewhere in this range, 9,400. It's going to line up with this previous resistance that we ran into on the way up. It would give us like, basically that resistance again, attempting to break through, put us at the top of our descending broadening wedge, and then, finally we could get the break back down or back up. But at this point in time, the trend is starting to look exhausted to the downside, but it is important to remember these oscillators and indicators can become exhausted and stay exhausted for extended periods of time in strong trending markets. And because we did like top out this pattern and everybody was thinking we were bullish here, or a lot of people were, it is possible we could see like a long drawn out sell off over weeks or months, especially depending what's going on, with like not only world conditions, world market conditions, and then, obviously like across crypto, stock markets, gold. We've been seeing massive sell-offs in every market, which, typically is a telling us a bigger picture issue may be at hand. Not to mention, we obviously know a bigger picture issue may be at hand or is at hand currently. So a lot of these patterns probably are going to continue underperforming. And I think what we saw in the stock market, I think that little bounce that we saw on Friday, that little bit of a movement, I think most likely that was people shifting assets and rebalancing their portfolios. So essentially, you have family offices, hedge funds, like big money. And when volatile moves like that start happening like crazy, it's their responsibility to balance their portfolios and make sure that, like, percentage wise, that certain amounts of the portfolio are like allocated to different asset classes, etc. So for instance, in the crypto space, say you normally have like 75% Bitcoin and 25% altcoins. If all of a sudden alt season kicks off and alts go up 3 times faster than Bitcoin does, you may end up with closer to like a 50-50 ratio between altcoins and Bitcoins. So essentially at the end of the month, which is what happened on Friday, that was the monthly close, it's your responsibility, or however you time it. In this case, it's the end of the month, or the end of a quarter. You'll balance out, those assets. So you might sell off a bunch of your altcoin positions now, and then, turn that money back into Bitcoin. You don't always just do it immediately all at once, though. A lot of times what you'll do is you'll take profits on the one asset that's going up extremely fast, that's throwing off your portfolio, and then you'll look for buying opportunities in, a reasonable time frame to allocate that money back into the asset classes to balance your portfolio. So that's, I think, what was taking place on Friday. So although people are trying to get bullish and saying, oh, that was a bounce, that's it, we're finding support now. We already blew through the key supports, and although we are at some supports right now, we're at less likely areas that we would reverse, I think. I think more people are going to see a key moving average and a Fibonacci level that line up together, and we have a better chance of seeing like a strong bounce or reversal than if you're just looking at a fib or just looking at a moving average, especially in traditional markets, where you have, a lot of eyes and a lot of money on those things. When you can get confluence is when you're going to get very strong moves. So, but again, we're basically at a point now where, we don't necessarily just need to start rushing back in on these assets and everything. And it is important, that we pay attention to the fact that, this catastrophe is only just beginning, and these tend to be drawn out over months or, years. You can see the effects of these things happening. So once you get like supply chain disruption, it's important to understand that not only have we not seen the actual effects of the disruption yet, but that not only, in this case, it's global scale supply chain disruption, so it's going to cause like businesses to go under. Not to mention, people will obviously pass away, unfortunately. So, you're literally going to have outside factors influencing, markets and the economy getting back on its feet. So that changes everything, changes the effectiveness of things like technical analysis and fundamental analysis. And it's very important, that you're wise with your money in these times and your capital, and that you preserve it. That way, you can wait until there is like stabilization, and once there is stabilization and agreement on prices is when you're going to see, a slow rise back up or whatever. But trying to like time the bottom and buy the bounces, that's really gambling. This is not financial advice. I'm not your financial advisor. These markets are extremely volatile, and we'll see more so than we've probably ever seen in our lives coming up in the next few months, or even potentially years. So. But anyway, there is one other thing I want to touch base on while I have you guys here, just because I always hear this being talked about, and it seems like, there's like a holy grail out there and no one can find it. And what it is it's the answer to why gaps get filled. And I'm not sure what all the confusion is. Um, it's very obvious. It's clear. And yet, I have heard like, you know, 10 or so influencers talk about it, specifically in the crypto space, and none of them seem to have any kind of like idea. I just hear people say, gaps get filled because they just do. Okay, you go back and they just do. They get filled. And then, they talk about, but you can't trade on that, or you can trade on that. Or, okay, look, the reason gaps get filled is